West Legal Ed Center and Celeste welcome you to today's program titled How the IRS Reconstructs Income Tax Fraud Cases. Program materials can be found under the Supplements tab. Use the Participation tab at the bottom of your screen to send a question to the speaker. It's my pleasure to introduce our speaker for today's program, Michael DeBliss. Thank you for joining us today. I'll now turn the program over to Attorney DeBliss.
Thank you. Hi, everyone. My name is Mike DeBliss, and it's my pleasure to be presenting today on this topic of how the IRS reconstructs income in tax fraud cases. A little bit about me. I am an attorney in private practice in New Jersey. I've been in private practice for, it's getting up there now, about 14 years. And I kind of fell into the area of tax law and tax compliance and defending criminal tax cases by accident. I was fortunate enough in the last year of my law school education to do an externship with a white-collar criminal defense firm that just happened to be starting a money laundering trial in the federal districts, in the federal district court. And I joined the litigation team that was representing the client at the time. And I quickly learned how unique and how specialized the area of white-collar criminal defense was, specifically financial crimes. I learned an enormous amount about financial crimes, from violations of the tax code to and violations of the United States Code to violations of Bank Secrecy Act statutes. It was so fascinating that it piqued my interest. And I knew I kind of put it in the back of my mind to go back and get some more education in this area so that I could zealously defend clients who were charged with such crimes. It was such a specialized area that it wasn't something that a recent law school grad could begin doing. So I sharpened my teeth in criminal defense by working at the public defender's office for a number of years. And while I was there, I went back to school to get my master's in tax law. And it was by design, because I wanted to marry my interest in litigation to my interest in tax law. But I realized that I was going to need a lot more education than I had in the area. And that's what brings me here today. I've been running a vibrant civil tax controversy practice for some years now, as well as defending criminal tax cases in both state and federal court. This is a topic that is near and dear to my heart. It is a bit dry, so I tried to bring in examples and hypotheticals at any time possible to drive home key concepts. And I deliver this presentation with an eye towards helping you as an attorney, deal with clients who might come to you in need of help. Whether it be an audit situation, whether it be an eggshell audit where the audit, could potentially go south. So, I also tried to fill you in a little bit on background information that is key and that is, necessary, that is like part of your essential kit of tools, if you will, as a tax attorney practitioner. So if you have any questions at any time, feel free to pop them into the chat. You're also more than welcome to email me after the conversation or after the presentation if you have any follow-up questions. So let's get started. So the way I start this presentation is to introduce the audience to tax evasion. That is the seminal and most heavy-handed statute that the U.S. Attorney's Office has when it turns to prosecute individuals who have engaged in tax evasion. It's the 800-pound gorilla, if you will. In all criminal cases, the government has to prove each element of this offense beyond a reasonable doubt. So it's no different than any other criminal statute. There are three elements of a standard tax evasion case. They are substantial tax deficiency, an affirmative attempt to evade tax, and an element that you are going to see come up time and time again. That is the element of willfulness. Willfulness is the mens rea element of tax, of criminal tax statutes. It's very similar to the knowledge element for street crimes, but it is a very heightened standard, as we're going to come to find out. When it comes to substantial tax deficiency, substantial is a term of art. It's a very critical definition, and it's also a fact-specific inquiry that's left up to a jury, which it must employ the everyday meaning of this word. The Third Circuit, though, has given us some guidance and has approved a definition of the term. It states whether the amount is substantial turns on whether, under the surrounding circumstances, the amount of the deficiency would be significant to an ordinary person. And so it isn't very useful. If substantial means more than noticeable, we're probably talking somewhere in the range of 15 or 20% in additional tax. And now we turn to the affirmative attempt to evade tax. In an analysis borrowed from criminal conspiracy laws, the government has to prove that the taxpayer formulated an intention or a scheme to evade the tax, and second, that the taxpayer committed at least one overt act in furtherance of that scheme. The statute uses the term attempts. Courts have added affirmative to the statute in order to emphasize the seriousness of the crime and to distinguish tax evasion from other less serious tax crimes. An example here is that a taxpayer may intend to evade tax by failing to file his tax return. There's also a separate statute that can be applied to charge such a person with the offense of failing to file their tax return, and that's separate and apart from the tax evasion statute. A failure to do something alone is not an affirmative attempt to evade tax. There also must be some other affirmative conduct to defeat the tax due and owing to support a tax evasion charge. This doesn't mean that the taxpayer gets off scot-free. He may be charged with the lesser offense of failure to file under Section 7203, which is a misdemeanor. So let's talk about this idea of willfulness. It's an elusive term. While it may be easy to define, it's not always easy to apply. The textbook definition of willfulness in the tax sense is similar to the definition of willfulness, and is actually identical to the definition of willfulness in the context of white-collar crimes. And that is an intentional violation of a known legal duty. This comes up a lot. Since I practice tax, it comes up a lot in other criminal tax statutes, specifically the ones involving the violation of the FBAR duty. An FBAR basically is called Foreign Bank Account Report, and individuals have an obligation to file an FBAR if they maintain a foreign bank account in a foreign country with a balance that has exceeded $10,000 US at any given point during the year. A failure to file an FBAR gives rise to a potential willful violation of the FBAR requirement, and there is, you guessed it, a criminal tax statute on the books for that offense. And the willfulness element of failing to file an FBAR is identical to the willfulness element that we see here for tax evasion. It's an intentional violation of a known legal duty. The taxpayer does not have to be an evil, insidious person, nor must they have acted with an evil motive or in bad faith. So what is required? What's required is that the taxpayer knew that he had a duty to pay the tax and knowingly intended to violate that duty. As courts have noticed, willfulness is a bit of a chameleon, which changes in color and tone according to the Internal Revenue Code section involved and the circumstances. So I do want to circle back a little bit to this FBAR, since willfulness comes up a great deal in the context of violating the FBAR by failing to file it. So what does the FBAR rule state? It states that a U.S. person, and by U.S. person, that doesn't necessarily mean a citizen. It could be a U.S. resident. There are some residency requirements that have to be looked at. And so all of these terms are terms of art, and you can't assume, or interpose your definition of what you think this term means. You always have to dig deeper and find out what the legal definition is under the statute. So a U.S. person certainly means more than a U.S. citizen. Green card holders apply here. Certain individuals that meet certain residency requirements as far as how long they stayed in the country could potentially be subject to this rule as well. A U.S. person must file an FBAR if that person has a financial interest or signature authority over any financial account outside of the U.S. and the aggregate maximum value of the account exceeds $10,000 at any time during the calendar year. In keeping with this theme of knowing the exact and precise definition of the terms, aggregate maximum value is a term of art because you could theoretically have multiple bank accounts, each one that had a high balance of, say, $9,900 at any given point during the year. You still, if you had at least two such accounts, you would not be able to dodge the FBAR requirement. And the reason being is because the definition here employs the word aggregate. Aggregate means that you have to take the high watermark balance of each of the taxpayer's foreign accounts. And if when they're added together, they exceed the threshold of 10,000 or the high watermark balance of 10,000, then that alone is enough to trigger an FBAR reporting requirement. These are some of the most commonly asked questions about the FBAR. And why do I take a divergence here? Well, FBAR reporting is a hot topic these days. It's been hot for quite some time right now, and it gave birth to the IRS's offshore voluntary disclosure program a while back. That program was specifically designed for taxpayers who were out of compliance with their FBAR reporting requirements. And because the penalties associated with failing to file FBARs are so burdensome and overwhelming, the IRS provided U.S. expats who this disproportionately affected an opportunity through the voluntary disclosure process to come clean and get up to date and current with their FBAR reporting obligations for a fraction of the cost that it would otherwise cost them if they were found out by the IRS before they voluntarily disclosed. And so it became a hot topic, and there were tons and tons and tons of articles written on Forbes and all over the internet about voluntary disclosure. And the IRS sunsetted the voluntary disclosure program several years back. But there is a sister version of the program called the streamlined procedures that are open to taxpayers who are non-willful. So the offshore voluntary disclosure program was specific and unique to those taxpayers that whose failure to file FBARs was willful, and they listed like a number of badges of fraud that would give rise to willfulness. The streamlined procedures, on the other hand, are designed for oversights and benign situations that that willfulness didn't cover in the context of offshore voluntary disclosure. The type of willfulness that and badges of fraud rather that go to willfulness in the context of these FBAR violations are bank accounts that are pretty high in value and that have high watermark balances in the 6-7 figures neighborhood. A failure to file an FBAR after perhaps the bank sent notice to the taxpayer that they had an obligation to do so. So there are a number of badges of fraud, and you can't say, well, if you have three against you, then that would give rise to willfulness, because you have to weigh each factor, and there are certain factors that are quite often death knells, whereas others may not necessarily contain the same weight that others do. So it's not necessarily if you have three or four on one side of the spectrum and just two on the other, that that you might be one and not the other, meaning willful and non-willful. You have to really go deep, and it's pick and shovel work. That's what I like to say. So these are some commonly encountered questions about the FBAR. The first is, how does an FBAR violation occur? Well, it can occur in one of two ways. It can occur first by failing to disclose a foreign account on an FBAR altogether, or second by disclosing a foreign account on an FBAR but underreporting the correct amount, the maximum value during the calendar year. Believe it or not, you do see the second one come about frequently. It's usually because the statements, though, provided to the taxpayer are not so accurate as you might otherwise think them to be. So it can tend not to be the fault of the taxpayer when they do file an FBAR, but when they report the high watermark balance as a lesser amount than what it actually is, because they're usually working off of the foreign account statements. And you have to keep in mind that we're dealing with foreign currency most of the time. So they have to extrapolate from the foreign currency to US currency and report it as US currency, the high watermark balance on the FBAR. All right, so now we come back to this element of willfulness. How do courts interpret willfulness for FBAR violations? Well, this is pretty much the traditional approach. They find that the only thing that a person need know is that he had a reporting requirement. And if a person had that requisite knowledge, the only intent needed to constitute a willful violation of the requirement is a conscious choice not to file the FBAR. If this language sounds familiar, you might recall studying it in one of your Crim Pro or Crim Law classes back in law school, because it's commonly referred to in legal circles as a theory of willful blindness. What does it mean for a defendant to be willfully blind? Under the theory, a jury may infer willfulness whenever a taxpayer intentionally fails to inquire and learn about his or her filing obligations. It's kind of the example that I think courts use a lot is like an ostrich that digs its head into the sand. So the slightest bit of information going to the taxpayer about this issue of FBAR reporting is enough to, in the eyes of the law, to put the taxpayer on notice that they have to, do some more inquiring and file their FBARs. That alone is enough. So if they had glanced at an article on Forbes about FBAR reporting, then then that could be an argument that the IRS makes that was enough to at least put them on notice. And the fact that they may not have done any further research upon seeing an article like that shows that they, like an ostrich, dug their head in the sand right away to keep themselves deliberately naive, or I dare say ignorant, of the law, to avoid learning more about it and what their individual obligations might be. So what this does is that instead of proving that the defendant intentionally violated a known legal duty, which is the textbook definition of willfulness in the arena of white collar crimes, the government need only show that the defendant consciously avoided any opportunity to learn what the tax consequences were. So that's a huge blow to the defendant. You can see here that that's really taking away a heightened standard of willfulness that the government would otherwise be required to prove, and substituting this watered down version of a defendant consciously avoiding any opportunity to learn what the tax consequences were. How does the government prove willfulness in the prosecution of a taxpayer for failing to file an FBAR? Seldomly are there any witnesses, and only in a rare case would a defendant admit the required state of mind. So, what does the government rely on? It relies on indirect evidence, not unlike most criminal cases. Specifically, conduct or acts from which a person's state of mind can be inferred. These acts are referred to as badges of fraud. This is what I like to think of as um, like the Humpty Dumpty test. You can't, you can't look inside a person's mind to see what they were thinking at any point in time at all, because our thoughts are our thoughts. They're private, and they're our own machinations or machinations. However, the law has always found that the actions of individuals give rise to what their thoughts are or were and what they were thinking at around the time of the alleged offense. And so this is kind of the concept behind badges of fraud. There are some common examples of badges of fraud that are sure to attract the IRS's attention. And again, we're sticking with the world of FBARs for the time being. A taxpayer, for example, who checks the box off no on a Schedule B. A Schedule B is that part of a 1040 that asks the taxpayer point blank, do you have an interest in or signature authority over a financial account in a foreign country? It's a very direct and straightforward question. So it's very hard to imagine that anybody could flub an answer to the question, because it's basically asking very simply, do you have a foreign bank account? And if you do, we want you to check off the box yes. So it stands to reason that a taxpayer who checks the box off no in response to such a question, that would be a badge of fraud that the IRS could rely upon. Whether the failure to report the account occurred continuously over a period of years, or whether it was merely an isolated incident. So are we dealing with one isolated incident that might have been just a complete aberration, or are we dealing with a pattern of conduct over a course of time that would really suggest that there was more of an animus or a willfulness involved? Did the taxpayer's failure to file the FBAR occur over the course of time or just 1 year? Whether the taxpayer failed to report a foreign account in a later year, despite having checked the box off yes on Schedule B of his tax return in an earlier year. That contradiction and inconsistency would definitely set the bells off in the IRS's office. And or whether the taxpayer filed an FBAR in an earlier year. This reveals that the taxpayer knew that he had an FBAR reporting obligation in the later year. The high watermark balance of the account. This is what I was harping on a little while ago. The amount of money at stake is crucial. Unreported accounts with maximum aggregate balances that are $500,000 or greater are heavily scrutinized. And there's a simple reason for this. The reason is that FBAR penalties are based on what the high balance was in the account. And it's a very technical formula, but it stands to reason that willful FBAR violations are penalized at a higher rate than non-willful FBAR violations. So there is a whole rubric that the examiner must go through to determine whether the taxpayer's failure to report the foreign account was willful or whether it was non-willful. Both schemes, both for willful and non-willful taxpayers, result in hefty FBAR penalties. But as I just said, willful FBAR penalties, of course, are penalized at a disproportionately higher rate than non-willful FBAR penalties. As one prominent tax attorney has once said, if a person has a 10 million bank account, I don't want to hear he was non-willful, and neither does the government. Another badge of fraud is whether the taxpayer told his tax preparer about the account. Another one is whether the account was held in such a way as to conceal ownership. Oh yeah, things get complicated very, very fast. I like to think of that nursery rhyme, oh, what a web we weave when we seek to deceive. It, the more complicated and complex the ownership forms are of a foreign account, the harder it becomes to explain, why these vehicles were in place. And foreign shell corporations or foreign trust, there are certainly legitimate reasons for having, for owning foreign accounts in these, in these special tax tax savings, creatures. But it becomes harder to explain when we don't have legitimate explanations for why we're holding them in these type of vehicles, and when the balance in the accounts gets higher. So was it in the name of a foreign shell corporation or foreign trust or some other entity that would make it difficult for the IRS to learn the true identity of the owner? Was the account a numbered account? Numbered accounts are basically a way to keep the account anonymous, so they don't identify the account holder by name. Instead, it's by a numbered account. You sometimes saw it in movies involving Swiss bank accounts owned by individuals in other parts of the world. Was a taxpayer issued a credit or debit card without his or her name being visible on the card itself? Did the bank help the taxpayer repatriate cash to the US using covert means? For example, did bank managers and their US clients use code words and emails to gain access to funds? So yeah, the IRS will act like sleuths and detectives here to get to crack the case. Did US clients ever use coded language such as asking their private bankers, can you download some tunes for us? This came out of a case, believe it or not, or note that their gas tank was running empty when they required additional cash to be loaded on their cards. You'd be surprised, how common this was at during a certain time period. Another badge of fraud, whether the taxpayer closed the foreign account and transferred the assets to another bank in the wake of a DOJ press release or media coverage reporting that the taxpayer's bank had become the target of an IRS summons demanding U.S. account holder information, or that it had agreed to participate in FATCA. FATCA is a mnemonic for the Foreign Account Tax Compliance Act. It's required by banks to follow this act in disclosures. A lot of banks, though, have fought back. And sometimes the governments actually would support the banks in the effort to fight back the US government to prevent them under FATCA, under this treaty, from disclosing account holder information. And so there was, there were huge legal battles mounted over a period of over a decade against FATCA. And, one of the most notable countries, Switzerland, finally capitulated to FATCA some years back. And as you can imagine, a lot of foreign account holders pulled their money out of the accounts, out of the Swiss banks that they previously had them in the wake of the Swiss government collapsing. So headlines splashed across the front pages of major newspapers, leading to taxpayers closing their foreign accounts and transferring these assets to other banks. That could be a badge of fraud if one of the banks that they happened to pull their money out of was one that that the DOJ just announced they were investigating. Another badge of fraud, whether a taxpayer who had a duty to file an FBAR checked the box off yes to the question, do you have an interest in or signature authority over a financial account in a foreign country? But no to the follow-up question, which is, if yes, are you required to file an FBAR to report that financial interest or signature authority? So most, individuals are clever, and if they answer yes to part A of the question, they are not going to answer no to part B because they've already, let the let the cat out of the bag. But yeah, there were sometimes situations like this where taxpayer would answer yes that they had an interest in a foreign account in a foreign country, but no to the question, must you fill out an F-bar? The amount of interest generated by the foreign account, and whether that interest was reported on the taxpayer's U.S. tax return. Ironically enough, because interest rates have been so low, even in foreign banks over the last 2 decades, there was never really the amount of interest generated was always negligible, even when the account values, soared to 7 figures or more. But nonetheless, this was something that the IRS would look at and consider a badge of fraud if there was significant interest generated by the foreign account, and if that interest was not reported on the taxpayer's tax return. If the interest was reported on a tax return, the IRS generally viewed the filing of an F bar as a mere formality. So in that case, a taxpayer could usually come into compliance with their U.S. tax obligations by filing a delinquent F-bar. And so there were some different schools of thought about how to come into compliance, one of which was a quiet disclosure, and the other was called a noisy disclosure. Noisy disclosures were those involving the offshore voluntary disclosure program, or coming out of the woodwork and letting the IRS know, ringing the bell, so to speak, that you had foreign accounts before the IRS ever knew about it. That's what was called a noisy disclosure. And you did that because you theoretically got rewarded by having done so, because the IRS would insulate you by protecting you from any type of criminal prosecution, and they would insulate you from assessing any backbreaking F-bar penalties or other civil tax penalties against you. But you would still have to pay a hefty fine, but that fine would normally pale in comparison to what you otherwise would be facing if the IRS had begun the audit before you voluntarily disclosed. So it's kind of like that situation that, if you were the possum and you were being chased by the fox, if you got out of your hole quick enough, or if you made it back to your hole quick enough before the fox could catch you, then you got an extra lifeline. But if you didn't make it back in time and the fox got you, then you were going to perish. And so that was an analogy or a metaphor that was usually used, much to the distaste of individuals that were in this position. But nonetheless, it is a tough pill to swallow for those who have not, been found out by the IRS or by the U.S. government yet, but who, could potentially be found out, and so they'd have to face the difficult decision of whether to come out and provide the IRS with the ammunition that they need to actually prosecute, but do it for the favorable and preferential treatment and for the peace of mind, of course, of not being, not having their case elevated to or passed to criminal investigations, and not facing back-breaking F-bar penalties. So there was a quiet way of disclosure as well, which was one involving filing delinquent F-bars and saying, forget about going through any voluntary disclosure program. I'm just going to file the delinquent F-bars, and I'm going to do a mea culpa. And a mea culpa in the tax world consists of what's called a reasonable cause letter, where you basically, rely on tried and true arguments for mitigation of penalties. And you, of course, have your tax attorney do a thorough, investigation and a thorough research to ensure that you have a strong argument to disclose this way, because obviously, if the IRS didn't agree, they could assess the full panoply of penalties, not just the F-bar penalty, but accuracy-related penalties, potentially the civil fraud penalty, and they could unleash holy hell on the taxpayer if they didn't think that their delinquent F-bar submission, or what we call quiet disclosure, was appropriate, especially in light of the fact that there were very friendly in their minds, in the minds of the IRS, voluntary disclosure programs that the taxpayer could have availed itself of. Another badge of fraud was whether the taxpayer instructed bank personnel to hold back bank statements and not mail them to him in the U.S. Another badge of fraud is whether the taxpayer had been the subject to a previous audit involving unreported offshore assets or bank accounts. And again, this goes to if the IRS got to you before you got to them. So it becomes a race against the clock. And then, of course, a number of foreign accounts held. Is it 1 or is it 6 or is it 12? No single factor is dispositive. It's basically totality of the circumstances. Ultimately, the juries must look into the mind of the defendant taxpayer to determine whether he intentionally violated the statute. To the extent that the government can show the jury enough badges of fraud, and that those badges of fraud were substantive and not just benign things that could be explained away by through legal means. So if there were a sufficient number of badges of fraud that were substantive enough after probing to disclose that they lean more towards nefarious activity, then there is a good chance that the government can prove willfulness beyond a reasonable doubt, and they will have satisfied their burden of proving criminal intent through circumstantial evidence. So you can see it's not as simple as in street crimes where the circumstantial evidence can be an eyewitness who saw a person running from the scene of an alleged crime right around the time it was committed. These are tax crimes, and we need to rely on these badges of fraud because this is sophisticated conduct that involves sophisticated probing. In civil cases, the burden of proof is on the taxpayer, but in the criminal realm, the government bears and always bears the burden of proof. The standard of proof is beyond a reasonable doubt. What does beyond a reasonable doubt mean? Well, it's defined as a doubt based upon reason and common sense after careful and impartial consideration of all of the evidence. It is proof of such a convincing character that jurors would be willing to rely upon it without hesitation in the most important of their own affairs. As for reasonable doubt, the Third Circuit has weighed in and approved the following instruction. A reasonable doubt is not a whim. It is not a speculation or suspicion. It is not an excuse to avoid the performance of an unpleasant duty, and it's not sympathy. So we as defense attorneys loathe this instruction. There are two aspects of the burden of proof, and it does get a little complicated in the area of tax and these white-collar crimes. The first is the risk of non-persuasion, or what is known as the burden of persuasion, or the second, the burden of production. It's important to distinguish between the two as the distinction impacts the outcome of cases. The risk of non-persuasion never shifts. It starts out on the government and it remains on them throughout. The burden of production, on the other hand, can shift with respect to particular issues in the case. The overall burden of persuasion never moves away from the government, but the burden of production sometimes shifts. Initially, the government has the burden of production as well, because there must be sufficient evidence to convince a reasonable juror that the defendant is guilty. This shift occurs in income reconstruction cases. So here's an example. It's a 72-1 tax evasion of assessment case. The government, and by the way, what does assessment mean? So in the area of taxes, it's very important not to confuse assessment with the layperson's definition of assessment. The basic Webster dictionary definition of assessment is that something has been like calculated or determined. So sometimes we get a little laid back as tax attorneys, and we'll use assessment in that sense to make it, to in the sense to represent that, yeah, the IRS calculated your penalties as XYZ. But assessment is actually a more technical term than that. Assessment means that the penalties initially um, initially applied against the taxpayer have now escalated to the point where they are officially the penalties that the taxpayer must pay. So assessment is pretty much the final stage of any audit. It's where we get to the point where it's beyond the time whereby the taxpayer can dispute the underlying liability. So when the taxes and the penalties are initially calculated, the IRS sends out what's called a revenue agent's letter or a revenue agent's report, and the taxpayer is afforded a number of rights, one of which is to file a protest and to have the dispute handled by the IRS appeals division of the IRS. They are considered to be neutral, even though they are an arm of the IRS itself, and they preside over the dispute and are willing to hear arguments from both the taxpayer and the IRS revenue agent as to the underlying tax liability. Obviously, the taxpayer is disputing the underlying tax liability. The examiner is trying to defend their position. If the case does not get resolved in IRS appeals, then the taxpayer has the absolute right to file what's called a petition in tax court. A petition is the key to getting a case docketed in the tax court. The difference between having, and by the way, there are other forums where a civil tax dispute can be heard, another one of which is our federal court system. However, there are substantial differences that make U.S. tax court a more favorable forum than the federal court, one of which is that a taxpayer, if they want their case to be heard in federal court and thus avail themselves of jury trial, if the case gets that far, they actually have to put up the amount that is in dispute and that the IRS is claiming they owe in an escrow almost before they get access to the federal court. So it's like before the federal court will accept jurisdiction of the case, the taxpayer has to front the amount that the IRS says they owe. Whereas in U.S. tax court, there's no such obligation. And the trade-off, of course, is that it is a different type of court. It's the judges are not standard judges. They are I forget what they call them right now. They're like magistrates in a sense, and there is no jury trial. So the judge is also the trier of fact and the finder and the trier of fact and the one who determines the law and applies the facts to that law. So not to do much of a diversion here, but that's how things typically work in civil tax cases. In this realm, we are dealing with a criminal tax prosecution of evasion. So we are in a federal courtroom, especially when 7201 comes up. The government in this case shows that Adam omitted $100,000 of taxable receipts from his return. The issue is whether the omission of $100,000 of taxable receipts proves beyond a reasonable doubt that Adam owed tax on an additional $100,000 of income and thus committed tax evasion. Let's just state the obvious here that when we're talking about $100,000 or a certain predetermined fixed value of receipts, that's not the same as what the tax liability is. So the tax liability on $100,000 of taxable receipts will, of course, be less than $100,000. It depends, of course, on what tax bracket our friend Adam is in. But nonetheless, we're dealing with Adam, and he omitted $100,000 of taxable receipts, and we want to know if that proves reasonable doubt that Adam owed tax on an additional $100,000 of income and thus committed tax evasion. By itself, this is insufficient to prove that there was additional tax due and owing. How could that be so, you might ask? Well, it's theoretically possible that Adam had unreported deductible expenses that either completely offset the omitted income or offset it enough that the resulting tax was no longer material and therefore was insufficient to sustain a tax evasion charge. So the purpose of this example is to hammer home this issue of materiality. So in a tax statute such as tax evasion, we discuss the element of materiality in the sense of substantial deficiency, because not all deficiencies of tax owed give rise to criminal prosecution under tax evasion. You can imagine how busy the government would be and how overwhelmed DOJ tax would be if they were to prosecute every person for having a tax deficiency. So the government, as you might imagine, is going to pick and choose their cases. And the less the deficiency in tax owed, the less likely it is that the government's going to come at the person with a criminal tax evasion prosecution. That doesn't mean that the government will not prosecute. There are other statutes, and we talked at the very top of some misdemeanor statutes that the government can avail itself of as well. But we want to hammer home the concept that not every tax deficiency rises to the level of a substantial tax deficiency for purposes of a tax evasion charge. The mere proof of unreported income is insufficient to establish additional tax liability. So what if Adam remains silent? Oh, the other point I wanted to raise in that last typo was that you have to put on your accounting cap. So look, I'm the first one to admit I'm not an accountant, and I sure in heck don't do my own taxes. I never will, I never have, never will, never have and never will. But you have to wear an accounting cap when you view these cases. And the reason being is because you have to have at least a general perfunctory knowledge of basic taxes. And so we all know that there are deductions, and we all take them every year legally, as professionals or as taxpayers in general. And so when we look at a case like this involving Adam, who has this $100,000 in gross receipts, we can't be plain Jane, so to speak, when we look at this example and say, oh, $100,000, that's a lot. We have to know that there are usually deductions that people take. And if Adam is a small business owner or a business person and earn these gross receipts, then it stands to reason that there are going to be a number of deductions that Adam is eligible to take just for running his business. He's probably got a myriad of deductions and write-offs that he would be entitled to. And why is that important? Well, deductions, of course, reduce the tax liability. And so if the deductions are enough to offset completely the the tax liability, or lower it to a point that the tax liability becomes lower than what the IRS would otherwise sink its teeth into for a tax evasion charge, then we save Adam from the 800-pound gorilla of the tax crime statutes. And so we've accomplished a small victory there. That doesn't mean that there won't be other charges, but this is a huge win in the sense that we protect him from a very lengthy prison sentence. And so that's why it's incumbent upon you to involve a forensic accountant when these matters get complicated, because you can't leave it to chance and to a general knowledge of tax. It's it's not enough. So what if Adam remains silent and doesn't suggest additional deductions or credits? Must the government go out and investigate every possible deduction? The Internal Revenue Code contains hundreds of deductions and credits. Well, the short answer to that is no. The government, it's not upon the The government is not responsible for checking off and or crossing off rather every deduction and saying this one doesn't apply, that one doesn't apply. They're not responsible for saying we investigated whether there's a child credit and there's no child credit here. We investigated whether Adam had more medical and dental deductions than were claimed on the return, but there are none here. And we looked at Adam's business and didn't find any accelerated appreciation deductions under 168. So obviously not. The government need not negate every and does not need to negate every possible additional deduction or credit. It's not part of their burden of production to do this. Instead, once the government shows that there's unreported income, the burden of production shifts to the defendant to identify additional offsetting deductions. So the defendant certainly gets their chance to raise these. And this is the dance, so to speak, that the government goes first. It carries the initial burden, and then the burden shifts. The burden of production shifts to the defendant to identify these offsetting deductions. The taxpayer defendant must indicate at least some basis for believing that these deductions exist. It can't be completely random and arbitrary. There has to be some basis for believing that they exist. For example, let's assume that Adam can produce evidence that he had expenses and deductions which reduced the tax to the point that it was no longer substantial. If he were able to do so, the government's case would fail, at least as it relates to tax evasion, unless the government can come back and refute Adam's version of events. Let's assume that Adam has some basis for believing that additional offsetting deductions exist. In that case, the burden shifts back to the government to negate the asserted additional deductions. Ultimately, it would be up to a jury to decide who made the more convincing case. So the summary here is that the risk of non-persuasion starts out on the government and ends on the government. The burden of going forward starts on the government, may shift to the defendant, as in this case, if there were deductions that they wanted to introduce, and then can shift back to the prosecution to negate those deductions. Theoretically, there could be further shifts. And if you think if this summary is enough to make it to be a little bit confusing, you can only imagine what it does to a jury when this is going back and forth and back and forth. It can be utterly confusing and mind-blowing, and it's almost like inserting a trial within a trial. I liken it to a situation involving impeachment or character evidence where the defense puts a witness on the stand who says something favorable about the defendant that is potentially, that potentially negates one of the elements of the crime for which the defendant is charged. So if the defendant is charged with, say, assault, and the defense puts on a character witness that testifies to the jury that Johnny, the defendant, is a pussycat and wouldn't hurt anybody, and then the prosecutor says, "Oh, wow, that just opened up the door because I know Johnny. I have his rap sheet, and Johnny has, 2 or 3 prior felony convictions. So, of course, if you're the defense attorney, then you actually, are going to face, a very serious repercussions on on appeal or post-conviction relief for this. But let's put that to the side right now. Let's say the government now wants to introduce Tracy, or wants to introduce, let's say it's bad acts for now. And let's say that Johnny doesn't have a prior record, but let's say Tracy was a friend of Johnny and knew Johnny to be a violent person, and then wants to put Tracy on in rebuttal to the favorable character witness. So you can see, like, it's a trial within a trial. And when is it going to stop? Well, the same principle here applies. It may never stop until the judge says time out, no more. Direct, indirect, and hybrid methods of proof. So now we're going into the weeds right now. Direct is going to be the most straightforward. Indirect and hybrid are going to really be mind expanding. So stay with me here. This section addresses the means or theories by which the government attempts to prove the tax due and owing element of tax evasion. These methods may be used either during the government's case in chief or at sentencing. Under the sentencing guidelines, the most important consideration is the amount of tax loss. That drives the time, so to speak. The larger the tax loss, the greater the period of incarceration for the convicted defendant. As unsettling as it might be, the government can attempt to prove, for sentencing purposes, a larger amount of tax liability than it attempted to prove at the guilt or innocence stage. So, right now, it's very important in your mind to distinguish between the trial phase of a criminal tax case and the sentencing phase of a criminal tax case. The reason being is because, yes, the government can sometimes play fast and loose here, and it's all legal. There's nothing that prohibits the government from doing so. So these cases do turn into chess matches. The government may have a direct, um, very direct, shut and close case or open and close case on a certain amount of tax liability. And yet, they might believe that the defendant has substantially higher tax liability, but the proofs may be a little bit weaker on, say, $30,000 of the $60,000 tax liability that the defendant has. So, what does the government do as a strategy? Well, the government doesn't want to taint their case if they have um, such strong evidence on $30,000 of tax liability, but weak, flimsy evidence on the last $30,000. Because if they were to put all $60,000 out there and the defense starts to poke holes in 30 of that $60,000, then it's almost like that principle of false in one, false in all. It then begins to cast doubt on the legitimate portion of that $60,000 that the government has very airtight evidence on. So the government doesn't want to risk losing the entire case for failing to prove this element because they brought the complete tax liability into the fold or into the case in chief. So what it might do in cases like this is allege a fraction of the total tax liability amount in order to get the conviction, because that is the goal. The goal is to get the conviction. Then the government can do a complete 180 at sentencing and say, well, we've got our conviction now, but we know that Johnny evaded substantially more than $30,000. In fact, he evaded to the tune of 60,000 or perhaps 120,000. And guess what? For purposes of sentencing, we're going to put the entire amount in issue. And we're going to argue strenuously that under the guidelines, Johnny's got to do X number of months of time, which is substantially higher than what he would otherwise have done for evading taxes to the tune of just 30,000. So we're going to put the entire amount in issue at sentencing because we don't have as high a burden to prove the excess amount at sentencing that we otherwise had at trial. So at trial, it's always beyond a reasonable doubt. The standard is not the same. It's a lesser standard of proof for the tax number at sentencing. So this is a strategy that's employed by the government time and time again, and yes, it is lawful. So as unsettling as it might seem, the government can attempt to prove, for sentencing purposes, a larger amount of tax liability than it attempted to prove at the guilt or innocence stage. Prosecutors can use a direct method to either establish unreported income or, in a few other cases, to refute the taxpayer's claims regarding expenses and deductions. Here are some scenarios. The first scenario is one where the government asserts it's right here. We can point to exactly what the problem is on this return. This deduction was claimed at $40,000, but it is legitimately only a $5,000 item. We can prove a $35,000 overstatement of deductions. You can imagine these cases the government is salivating to take to trial because they merely have to put the documents on their overhead in the courtroom, and the jury, all they have to do is a stare and compare, and the government is all too willing to put them up side by side, the return and the and the deductions that were taken, and you can see right away the inconsistency, and it can be made out. It's in black and white. It's for all the world to see, and these are the easiest, most slam dunk cases for the government to prove, these direct method cases. In scenario number 2, taxpayer got $75,000 worth of receipts from person A. These receipts were taxable, but the taxpayer never reported them on his return. IRS's argument: we can identify precisely where it is on the false return and how it gave rise to the additional tax liability due and owing. Typically, the government compares the claimed or reported amount on the return to the actual receipt, and abracadabra, it effectively meets both the burden of production and the burden of persuasion, because it is almost impossible for a defendant to explain away direct proof of this type. In other cases, these receipts can fill in the blanks in an allegedly fraudulent return. The government, as you can imagine, greatly prefers direct methods to indirect methods. So direct methods always start with the taxpayer's return. When the taxpayer has filed a return for the year in question, the government introduces it. It's usually Exhibit A. In doing so, the IRS uses the taxpayer's admitted income as a baseline. Oh, and by the way, these cases, of course, are tried by attorneys that are in DOJ and that have a substantial knowledge of tax and the tax laws. I found that most of them possess backgrounds in accounting and have masters in tax law, and have experience litigating financial crimes and white collar cases, having worked in the AUSA's office. So they are from DOJ Tax, which is a department in the Department of Justice in Washington. They are very well versed in the tax laws and in litigation, so they combine a 1-2 punch. These direct methods always start with the return. When the taxpayer's return is filed for the year in question, it's introduced, and the IRS will use the taxpayer's admitted income as the baseline. For hearsay purposes, the return is deemed the taxpayer's admission as to the items included on the return. Therefore, it's admissible. We have an example. Let's say that the return reflects $40,000 of gross income. The government can treat that amount as a given. The defendant may later state, oops, I was wrong. I didn't have 40,000, only 30, but that is a tough road to hoe because taxpayers don't typically overstate their income on returns. I think that if the jury, using their common sense, would realize that this is self-serving in trial. Second example, the taxpayer wants to dispute additional unreported income by asserting additional deductions. The fact that these additional deductions weren't on the return constitutes an admission that there weren't any additional deductions. So you see how damning the admission of the return itself is, because the taxpayer defendant is now hamstrung. Their hands are tied. They can't, make an assertion like the one here or the one you saw in the last example, because the return speaks for itself. Criminal numbers, sentencing numbers, and civil numbers. Typically, these three numbers diverge. This is getting back to what I talked about a little earlier. The government will be the most conservative where it has the highest burden of proof, beyond a reasonable doubt, at the trial stage. Therefore, it's not unusual for the government to use different amounts during the guilt-innocent stage and the sentencing stage. At trial, there might be more unreported income than what the government asserted in the guilt or innocence phase of the trial. For example, the government might believe that there is 110,000 of unreported income, but only 30,000, but rather 30,000 of that could go either way. Why? Well, very simply, there might not be enough evidence to prove evasion of $30,000. So, what we know here is that the government seems to have a slam dunk case on on $80,000, which is 110,000 of unreported income minus $30,000. So $80,000 is airtight. The government has airtight evidence and to prove that there was $80,000 of unreported income, but as we know from the example, 30,000 is a crapshoot. In that case, the government will assert only 80 during the guilt or innocence phase. The government typically introduces rock solid, hard, unshakable evidence in the guilt or innocence stage. Why? Because if there is the smallest shaking or rumbling, this tends to introduce reasonable doubt and gives the defense attorney the opportunity to argue to the jury, you know, the 30,000, you can see the government was reaching for straws here. So think about it. Use your common sense. They were reaching for straws. If they were reaching for straws on just $30,000, then what lengths would they have gone to reach for straws in 80,000, which is more than twice 30,000. So you can see that the defense, this is an invitation to the defense attorney to just go crazy. And it's certainly a tactic that that the defense will hone in on and argue zealously as they should for their clients. False in one, false in all. That's how I look at it. If one part of it's tainted, then how can you believe that the other part isn't? If the other part is even more than the part that the government went to great lengths to try to prove and couldn't. For this reason, the government usually selects a smaller number at the guilt or innocence stage. At the sentencing stage, yes, the government goes for more, and they can. They can go for that additional $30,000. On the civil side, the government will always seek the maximum. So if it's 110, they're going for it because it's a lower standard altogether. Let's return to Adam. The service might only establish 75,000 in unreported income during the guilt or innocence stage because the evidence regarding the other 25,000 is shaky. Later, at the penalty or sentencing phase, the prosecutors can use the 100,000, the full amount, to maximize the criminal penalties against poor Adam. And it does sound unfair, and really like heavy-handed, and over the top, but it is allowable. Let's talk about indirect methods. In all criminal cases, if there is no smoking gun, the prosecutor has to rely on circumstantial evidence. And so what is circumstantial evidence in indirect methods? Well, the government may argue that there is circumstantial evidence which logically leads to the inescapable conclusion that the taxpayer's return is wrong, even though the government can't point to exactly what it is. So you can see that there is like an inherent contradiction here. And if you're sensing that this doesn't really pass the smell test, well, guess what? You're right. The courts are very skeptical and very cynical of indirect methods. And as you can imagine, far prefer direct methods to indirect methods and make the government accountable to prove, why direct methods is not a satisfactory approach in presenting their case before the government will allow them to build it on an indirect method theory. It's subject to heightened scrutiny. That's what I was trying to explain. Complicated and difficult to explain to juries. So, as you know, if it's easy to get lost in the weeds here, and so you can imagine how difficult it is on a jury. Because of their potential for mischief, appellate courts closely scrutinize indirect methods. Therefore, the chance of reversal on appeal is great. There's a multi-step process here, and the government has the burden of establishing the following. Number one, that a direct method is not available or is unreliable. I'm just going to go through the elements and then come back. Number two, a likely taxable source for the unreported income. Okay, and I think we can go back and we can fill in the gaps now. So a direct method is not available or is unreliable. What do we mean by not available? Well, what we're talking about here is that the taxpayer's books and records are unavailable, possibly because the taxpayer never kept them or lost or destroyed them. The latter two tend to be the more likely reason, but there are taxpayers, believe it or not, who run multi-million-dollar companies who don't keep books. Unreliable. Well, the taxpayer's books and records are available. So unlike not being available, they are available, but they're not reliable, meaning that they contain errors galore. So that's why those two reasons would tend to back up the government's claim that a direct method is just not available or is unreliable when they stand up before the court to argue that indirect methods is the only way that they have to prove their case. This barrier prevents prosecutors from ignoring hard evidence that may not be as damning in favor of circumstantial evidence that artful lawyers can doctor up. So that's, a very skewed, version of things based on, my defense, my proclivity to, to being on the side of the defense. Yeah, I do believe, sincerely that there are some prosecutors who, may believe that there is, that there is a direct method, but that it's just not slam dunk, and there are too many holes, and so they, may be persuaded to, look to an indirect method where, they might be able to potentially doctor things up a little bit. And so this, of course, gets, veiled in the disguise of, we have no direct method. So it's incumbent upon the defense attorney to really probe deep here and thoroughly and, argue crazy to the court if, in fact, it appears that the direct method, it has as many holes in it as Swiss cheese and would be more easily defensible than the alternative of indirect methods. The second element that the government has to prove is that there is a likely taxable source for the unreported income. The government must show some source from which the taxpayer was likely to have gotten the unreported income. For example, Adam may have reported $100,000 of income from a consulting company in 2015 and nothing in 2016. If the judge determines that the prosecutor has met both elements of the preliminary test and therefore may use indirect evidence, there are 5 approved models. This is what we're going to talk about. There's a net worth method. There's an expenditures method. There's bank deposits and cash expenditures method. There's a percentage markup method, and there are indirect methods to prove overstated deductions. These are accounting methods, and so it gets very cumbersome very fast to try to talk about them with using layperson's definitions because it's a very accounting based. These are very accounting based methods of regenerating gross income. So I'm going to give you an overview of each of them, but this is of course not the be all end all, and I've done the best I could to make it as easily digestible as I can for a general audience that does not have background in accounting, and I, for one, am the first to admit that I don't. So this is kind of how I understand things, and I just want to let you know from the get-go that this is a watered-down version and very generalized. So net worth method. These are attempts to demonstrate that the taxpayer had more taxable income than what was reported. How? By showing that the taxpayer had an increase in his or her net worth, an increase that could only have come from taxable income. The government has to establish its case through the net worth. The government rather establishes its case through the net worth method in the following steps. It establishes the defendant's opening net worth using cost basis. Again, this is a fine term of art in the accounting world. Typically, these are multiple tax years. The government shows at the beginning of the first prosecution year the defendant's net worth. Net worth must be calculated for non-cash assets at a cost basis, not fair market value. If the taxpayer's asset appreciates in value before a realizable event, such as a sale of those assets, the taxpayer does not have income, and unrealized appreciation is not taxable income. The government shows increases in net worth at the end of each of the years for the prosecution period. The government subtracts any known non-taxable receipts. Increase in net worth and any acquisition of new assets may have been financed by income that wasn't taxable. The government must prove willfulness directly or by inference. So there are reasons why the government prefers to use the direct method over the net worth method. Appellate courts are suspicious of indirect methods and will allow their use only if the government has no other recourse and only if the method is applied strictly. There aren't as many IRS agents who are skillful in applying the indirect methods. What are some common defenses to net worth cases? The net worth increase shown by the government is not an increase at all because of the existence of substantial cash on hand at the starting point. Another common defense is that the net worth increase is attributable to some non-taxable source. A third is by attacking the accuracy of the government's opening or closing net worth figure. The net worth increase shown by the government is not an increase at all because of the existence of substantial cash on hand at the starting point. So what I'm doing is I'm going back to each one of these defenses that I just listed for you, and I'm going to try to give you some context to each. So for number one, the defendant would have to testify, I had a cash hoard which I had built up over the pre-prosecution years and which I didn't spend until the prosecution period. That's what supports the increase in my net worth. I used the money from this cash hoard to buy these additional assets, not from unreported taxable income. So again, this is cash that was on hand from earlier years than those that are at issue in the case, which are the prosecution years. Cash hoards are stuff like you've probably heard or watched in, in movies. They're usually hidden inside mattresses or in PVC pipes underground. What are some of the potential sources of a cash hoard? Non-taxable sources or taxable sources in years as to which the statute of limitation has already expired. How does the government rebut the cash hoard defense? Well, the government has to essentially prove a negative that there was no cash hoard. They can do so by relying on admissions made by the taxpayer, and they can rely on financial statements given by the taxpayer to federal or state agencies. And this is again talking about rebutting the cash hoard defense. Reconstructing the taxpayer's income from pre-prosecution years using tax returns and other information to show low amounts of prior income. So if there isn't a lot of income listed on prior year returns, the government can legitimately ask, where did that money come from exactly? Now you're saying that it occurred in a pre-prosecution year. Well, that's interesting because you're saying that you had $30,000 of cash during 2007, which was 1 year before the prosecution year of 2008, and yet you only reported was it $15,000 of gross income in 2007. So what's going on here? How could you claim you had a cash hoard in 2007 of 30,000 or more when you only reported $15,000 in gross income? So did you commit evasion in 2007 but just not 2008? What are you telling us, taxpayer? So it's a double-edged sword. You got to be careful here. So if there isn't a lot of income listed on prior returns, the government asks, where did the money come from? Maybe the answer is non-taxable sources. Well, that's interesting. But the taxpayer nonetheless has to identify who died and left him their money. Establishing a history that casts doubt on the idea that the taxpayer had cash lying around, such as the taxpayer filing bankruptcy or borrowing money. So, if the taxpayer, I mean, this is where, oh, what a web we weave when we seek to deceive. You've got to ask all of these very difficult, inconvenient questions of your client up front, because the boomerang effect can oftentimes be worse than what's than the initial crime itself. The cover up, that's what I'm trying to say, can be worse than the initial crime itself. But if it stands to reason that if the taxpayer filed a loan application in the very year that they're saying they had $100,000 in cash hoard, I mean, something's got to give here. Or if they filed a bankruptcy petition in that year when they claimed that they had $100,000 or more of cash, this is all going to lead to scrutiny. So these are questions that the IRS loves to ask. Does the taxpayer have significant balances on their credit cards? If so, why? Why did the taxpayer have, a $20,000 balance on their Chase credit Visa card when, they claim to have had 80,000 or more in a cash hoard lying around? If the taxpayer had this cash, why didn't he just use that cash to pay off the credit card to avoid well, this is really high. 22% is obscene. It's not that bad, but, why didn't they use that, that cash on hand to avoid a 12% interest rate? Why did the taxpayer have to file bankruptcy if he had all of his cash lying around? Why did the taxpayer have to borrow money if he had all this cash lying around? Why was the taxpayer living below the poverty level? And or why did the taxpayer file a low-income housing application? So, man, there's so many ways to get caught here. The next thing is that the net worth increase is attributable to some non-taxable source. Well, there are various sources that are not considered to be gross income. It's in the Internal Revenue Code, and it lists them out. It's one of the easier provisions to wrap your head around in the Internal Revenue Manual. But suffice to say, gifts, inheritances, and loans may not account for newly acquired wealth because it's not gross income. Example, my auntie died and left me $100,000. My brother lent me $10,000. I got a loan. The government has no burden to negate this defense until the taxpayer puts it into play. How much detail must the defense give the government and when? It's necessary to give the government this information with sufficient specificity and with sufficient timeliness. If the defense fails to do either, then the government is relieved of its obligation to negate the item. An example. An IRS investigation showed that the taxpayer had an opening year net worth of 50 grand. The taxpayer had a checking account with $50,000, which was the only asset the IRS could locate. The net worth method conclusively proved that the taxpayer had $57,000 of unreported income in the 2-year period. Taxpayer's argument: the method is flawed because I had an opening net worth in the form of an inheritance that the IRS did not identify or verify. 1 month before the opening date of the 2-year period, the taxpayer received a $50,000 inheritance from Aunt Sally that was non-taxable. He went to Las Vegas, cashed it there, and lost it all within days. Had the taxpayer retained the $50,000 past day one of the 2-year period, it might have accounted for enough of the indicated income that the government would not have pursued an evasion case on the $7,000 that remained. So again, if the taxpayer had retained that $50,000 past day one of the 2-year period, it might have accounted for enough of the indicated income that the government would not have pursued an evasion case on the $7,000 remaining. But because the cash had been spent prior to day one of the 2-year period, the net worth method correctly indicated that the taxpayer had 57 of unreported income. So what's the issue? Assume that the IRS could not exclude the possibility that the taxpayer held all of the cash on the critical opening date. Can the taxpayer's attorney affirmatively advise the IRS that the inheritance accounts for $50,000 for 50,000 otherwise unaccounted for cash on the opening date? What is the relevancy of this? Well, it eliminates the net worth method as a means to obtain the conviction. The answer is you can't say to the government, your figures are wrong because you did not include this $50,000 inheritance. Why? Well, misrepresenting a known false fact violates a section of the code, 1001. But the attorney could ask the IRS special agent if he considered the inheritance just 1 month earlier. It's a suggestion, not a statement. By asking this question, the attorney merely implies that the money might have accounted for some significant part of the otherwise indicated unreported income. I know it's like semantics here, but is that implication sufficiently close to a statement that the defense counsel still has an ethical problem or a 1001 problem? Well, the rationale here is that the defense has the right at trial to challenge the method used by the government to identify opening net worth. Therefore, defense counsel should be able to ask the agent whether a significant item that should have been considered but wasn't could impact the government's application of the net worth method. Attacking the accuracy of the government's opening or closing net worth. That is another way of defending against this net worth method. This argument is just straight up, you crunch the numbers wrong. An example is that the opening net worth, this might be the summary of the defense. The opening net worth that I had was greater than you thought it was. Therefore, the difference between opening and closing net worth was less. Or the closing net worth was less than what the government thought it was. So again, what we're talking about here is like a math calculation error where the opening net worth that I had was more than what you thought it was. Therefore, the difference between opening and closing net worth is less, or that the closing net worth was less than what the government thought it was. While the government may be able to prove with reasonable accuracy an increase in net worth over a period of years, it often has great difficulty in relating that income sufficiently to any specific prosecution year. That's why the government seldomly brings a single year indirect method case. In recognizing the potential inaccuracies of this approach, what do the courts do? Well, the judges approach these cases with the realization that these imprecise methods might ensnare innocent taxpayers in the coils of prosecution. So they do, embody a healthy dose of skepticism here. Jury charges should be crystal clear, including a summary of the nature of the net worth method, the assumptions on which it rests, and inferences available both for and against the accused. Appellate courts should be particularly keen and vigilant to make sure that the trial judge did his job or her job and that there wasn't an inappropriate conviction based on a faulty use of the indirect method. Now we turn to expenditures method. I'm just going to take a short diversion here because I have to read you a program code for the program. I believe it's for those seeking New York credit. The program code is M, that's the first letter of my first name, and then D, the first letter of my last name, to Bliss, and then it's followed by a series of numbers. So it's MD3355-31023. Okay. Now we turn to expenditures method. This is also known as a source and application of funds method. If the taxpayer wasted his substance with riotous living, to borrow a phrase from the story of the prodigal son, the service cannot use the net worth method and must convince the jury that the taxpayer spent so much money that there must have been an additional income somewhere. When I hear this, I oftentimes think I'm a huge fan of Shakespeare, and I love Henry IV, who, as you might remember from taking a Shakespeare class back in college, was the son of King Henry the Fourth. So it was Prince Hal. He later on became Henry V, King Henry V. His father was a notorious raging king, and he led a youthful life of proliferation. Going to the pub, drinking. He was a womanizer. Engaged in all sorts of a riotous living, as you might see here, and then finally wisened up and realized that he was the heir successor to his father to the throne. He did have two siblings, but as the oldest, he was the successor to the throne, and so he did a complete about face and basically proved his loyalty to his father by going out on the field and killing his father's nemesis, who happened to be Percy. Percy was an acclaimed warrior during the time who had a number of victories in various battles, and was considered very menacing, and everyone feared him. Prince Hal, of course, was had a very privileged upbringing and didn't fight at all, but led this extravagant lifestyle. And through Shakespeare's rewriting of the play, because he did take some creative license, he put Prince Hal in hand-to-hand combat with Percy on the battlefield, and Percy killed his nemesis, and then earned his father's loyalty and became the king. So that's just a quick deviation. But in here, we're talking about the taxpayer pilfering his substance with riotous living. The service cannot use a net worth method. They must convince the jury that the taxpayer spent so much money that there must have been an additional income somewhere. The difference here is that if the taxpayer uses additional unreported income to acquire assets, then the net worth method applies. But what if the taxpayer doesn't acquire assets, but instead spends it on high living, not involving any fixed or portable assets? In that case, the government employs the expenditures method. The government establishes opening and closing net worth. So the government needs to show that expenditures did not come from drawing down previous assets. So they have to negate something. The government must show the amount of expenditures made by the taxpayer during the year. The government also has to deal with non-taxable sources. There's a case here, Taglianetti versus U.S. The defendant's chief argument was that the government failed to establish opening and closing net worth figures with accuracy. The First Circuit held that the IRS must only establish an opening and closing net worth with reasonable certainty. The analysis here is that although the amount may not have been established with laser-like precision, what was established was that the net worth at both the beginning and at the end of the prosecution was roughly the same. As long as there wasn't a decrease, then the expenditures could not have been funded by drawing down previous assets. Opening and closing net worth is significant in a comparative or a relative sense, but not in an absolute one. Now we turn to bank deposits and cash expenditures method. This is what's called a hybrid method because it involves two different methods that have been combined or fused together into one. It basically combines the first two. It assumes that deposits into the defendant's bank account and expenditures made by the defense are taxable income unless they came from a non-taxable source. The two chief advantages to using this method are one, that the government need not establish opening and closing net worth, and two, the government need only produce sufficient evidence for a reasonable juror to find fraud, as opposed to any of the classic fraud badges, which hidden accounts or duplicate books would fall under. We have an application of the hybrid approach that comes to us from the case of U.S. versus Esser Circuit Court. I'm not sure what circuit. I apologize, but if you Google it, it'll come up. There were 3 tax years in question. The government charged a defendant under tax evasion, 7201. In bank deposit cases, it's customary for the government to introduce deposit slips. However, in this case, it was virtually impossible to introduce deposit slips due to their poor quality, unreliability, and unavailability. Instead, the government introduced bank statements and pass books as the most reliable evidence available. The defendant strenuously argued that the bank deposits theory required an analysis of bank deposit items themselves. The government had a duty to specifically identify and analyze the defendant's deposit slips, and the failure to do so was fatal to the government's case. The court held no. This was a jury question, and that it was up to the jury to decide whether there was satisfactory proof of the deposits. There's no one legally required method. If the jury thinks that it's sufficient, that's good enough. The defendant wasn't done yet. They had a second argument, and he argued that the government failed to prove willfulness. The court there held no. Willfulness can be inferred by the jury as long as there was a satisfactory evidentiary basis for that inference. The reasoning here was there was no evidence of the classic badges of fraud like duplicate books and hidden accounts. However, the government presented sufficient evidence to allow the jury to find that the defendant engaged in a pattern of understating income for 3 consecutive years. That was sufficient to give the jury the right to infer willfulness. So that's a fatal blow to the defense, because that gives the government another arrow in their quiver to rely on, a ruling, a court ruling that the fact that a defendant engaged in a pattern of understating income for 3 consecutive years gives the jury the right to infer willfulness. So I think what we're seeing here is the court really hammering and further diluting the willfulness element, which, as we all know, is the most vital element that the government must prove in any criminal statute involving the potential loss of a defendant's liberty. The percentage markup method, it's much more common in civil cases than it is in criminal cases. In criminal cases, it's not the principal method of proof. Instead, it verifies or corroborates understatements established by more reliable techniques. It's used when the taxpayer is in a trade or business. The IRS sometimes takes the inventory, multiplies it by a predetermined profit margin to arrive at an unreported income figure. The profit percentage may come from general industry averages. There are a lot of holes in this method, not the least of which is that item markup varies greatly under different circumstances, so the service normally only uses this method in civil court where there's a lower burden. There are potential defense arguments here. The first one goes a little bit like this. My business does worse than the average. The fact that the industry has an average 16% profit doesn't mean that I have a 16% profit. And it makes sense. Another argument against this method is, quote, ideal in several different kinds of products, and there are different profit percentages on these different kinds of products. This means complex calculations. So what if the percentage changes? Taxpayer sells a number of different products, but in varying percentages over the years. When taxpayers underreport income, they often underreport their deductions for cost of goods sold. That is, they understate the amount that they actually spend on inventory. By doing so, that gives the impression that they had less inventory and less merchandise. Therefore, they sold less and had less income. By understating deductions, that covers up a bigger understatement of income. So you can see, like, it's a dog kind of chasing its tail here. Where the taxpayer, who's, underreporting income, often underreports their deductions for the cost of the goods. They understate the amount that they actually spent on the inventory, and that gives the impression that they had less inventory and less merchandise. Therefore, they sold less and had less income. And so by understating the deductions, that covers up the bigger understatement of income. So in the scheme of things, underreported income, as you might imagine, is gives rise more so to criminal prosecution than overstatement of deductions. So it's very important to distinguish that because if you're not familiar with this area, then it might, logically speaking, be something where you might think, well, overstatement of deductions has the same impact as underreporting of gross income. But no, understating gross income is a far more severe violation, giving rise to tax evasion, than overstatement of deductions. The understatement of inventory is itself an affirmative act. If that term sounds familiar, it's because it was one of the foremost elements of tax evasion. Indirect methods to prove overstated deductions. The main use of indirect methods is to establish underreported income, but on rare occasions, indirect methods can be used to establish overstated deductions. It's something of a reverse net worth argument where the IRS tries to prove that the taxpayer didn't have enough income to claim certain deductions. This method assumes that the taxpayer didn't have any leftover money from earlier years, and that's often a tenuous assumption. The government's argument that the taxpayer overclaimed deductions for employee business expenses on the return. As a preliminary matter, it's hard for the government to prove an overstatement of deductions. In the criminal context, if the taxpayer's return says that he spent $40,000 on deductible items, the government must show that $40,000 wasn't spent on deductible items. How would the government do that? Well, does the government ask everyone that the taxpayer has ever done business with, how much did the taxpayer pay you and for what? Obviously, no. The taxpayer, might have like uh eight dozen, customers. So it's unfeasible for the government to go to each one and ask them point blank, how much did the taxpayer pay you and for what? In this case, the government argued that the taxpayer did not have enough income to make the expenditures that he claimed to have made. Therefore, the deductions must have been overstated. It's a reverse net worth method argument. After the government presents its case in chief, it's customary, as is the dance, for the defense to move for an acquittal on the grounds of insufficiency of evidence, directed verdict. The defense did just that, and the court granted the motion and dismissed the case. The court's analysis was that the government's proof consisted of nothing more than that the taxpayer didn't have any money generated by the activity in the year in question. That doesn't establish whether the taxpayer had money generated by previous year's activities outside of the prosecution period. And you might think that you might recall that that sounds familiar. It doesn't establish whether the taxpayer had money generated by previous year's activities outside of the prosecution period. That came up in the talk for the direct method, or I'm sorry, for the first indirect method, that there was a cash hoard, if you recall. Appellate review. When an appellate court reviews the sufficiency of evidence, it does so in a light most favorable to the party for whom the jury gave its verdict. So if the verdict, of course, it's going to be the defense appealing, and of course, the jury would have handed the government a guilty verdict. If the defendant is convicted, questions of evidentiary sufficiency are evaluated in a light that is most favorable to upholding the conviction. Having expended the judicial resources, courts don't want to undo the verdict and try the case a second time. In other words, if the jury convicts the taxpayer must prove on appeal that the evidence was almost laughably inadequate and that no reasonable juror could have possibly voted to convict based on that proof. So it is a very, very high standard, and one which is not so readily granted. Very few of these cases come back on appellate remand. So what is a defense strategy in an indirect method case? Providing the IRS with leads or hints of leads can potentially set the stage for attack on the base that the agents passed up reasonable leads. Of course, the lead must suggest some potential relief to the target so that it is fair to reject the method for failure to pursue the lead. Hybrid methods. Various indirect methods can be combined in hybrid kinds of approaches as long as that does not create confusion. So closing remarks here as we wind down. Anyone who has ever faced off against the IRS knows all too well that this agency means business. They have a number of tools to collect what it claims the taxpayer owes. And in an audit situation, these tools are powerful and, yes, very frightening and intimidating. They are still present in criminal court, even if there is no direct evidence supporting an income evasion claim. I'd like to just make one side note here. We talk about DOJ tax being the prominent arm of the Department of Justice that handles these prosecutions. They are comparatively small, and so their edict, if you will, is to really maximize the deterrent value of prosecuting individuals for tax evasion. And so, as you can imagine, they go after big fish, not small minnows. They generally will go after those from Hollywood and those that, the public it has a fascination with and idolize and worship, to make an example out of them and to instill the fear of God in those that might otherwise think that because their neighbor omitted income in their last 10 years of returns, that they can get away with it in this year's filing. So again, it's designed to maximize the deterrent value based on the fact that they have scarce resources. And, they will definitely also make examples out of professionals such as accountants and lawyers themselves. So it is very, imperative to fully disclose and, encourage your clients, to come back into the fold of compliance. But of course, taking into consideration their best interests and zealously advocating for them. So yeah, there are also cases that I just want to also add this. There are also cases that the Department of Justice will farm out to local AUSAs in regional DOJ offices to prosecute for tax offenses. This normally happens when they accompany bigger offenses like white collar crime offenses, such as money laundering. There's inevitably a slew of tax crimes that will go along with money laundering. And to protect the scarce resources that they have, DOJ tax might assign a criminal tax prosecution to a AUSA in one of those local DOJ offices to prosecute that crime, in addition to the myriad of white collar crime offenses that they're already tasked with prosecuting. So these tools are powerful and still present in criminal court, even if there's no direct evidence supporting an income tax evasion claim. That's what we spent the lion's share of the time talking about, these indirect methods. Nevertheless, the harder DOJ tax must work to obtain a conviction, the higher the likelihood of a positive outcome for the taxpayer. There are always ample opportunities to sit down at the table and talk. These cases are complicated cases that take long periods of time to try. And suffice to say, even with a very strong government case, the government is willing to lend you their ear, uh, like Mark Antony, and sit down and talk. But they're not going to give away the courthouse, as you can imagine, especially when it's a direct method case and it's one where they merely put the tax return on the screen and next to it put the tax receipts on the screen to prove that the that there is a deficiency in tax liability and that the jury merely do the stare and compare and come to that realization by just seeing it in black and white. So you have to have that talk with your client, but you have to really look at these cases in a thorough, deep way and take into consideration any and all deductions that the client might have otherwise been entitled to see if that offsets the gross income to a level that puts it below substantial tax deficiency, and thus out of the coils of a criminal tax evasion case. But that doesn't mean that you're home free, because there are a myriad of other tax crimes that we didn't even get into in this presentation. So I hope that this was a helpful primer to you all, and I encourage you to reach out for me if you have any follow-up questions. It was a pleasure to present today, and I wish you all the very best.